the 11th concept is the conservatism concept. Conservatism concept implies that we should account for all known expenditures or all known losses, and at the same time we should ensure that we do not account for revenue till we are very certain of earning the same. You must be slightly apprehensive of what I have just spoken at point number 7, revenue recognition, that revenue must be accrued. Revenue has to be accrued, but there is a small but, only when we are very certain about earning the same. So in case let us suppose we have sold the materials to a customer and suddenly we come to know that the customer is going bankrupt. So in such a situation, even though we have accounted for the sales, we will go ahead and we will make a provision for doubtful debts. Now this is being conservative. We are not recognizing the revenue, knowing fully well that the affairs of my customer are not in proper shape. So this is known as the principle of conservatism. And at the same time, taking other examples, we should account for all our known expenses and losses. We should accrue at the year end. That's the reason why we make provision for unpaid rent which has already become due. We make provision for unpaid expenses which have already been incurred. At the same time, any particular income which is not certain, which the company may or may not earn, is not accounted for. Now this is known as the principle of conservatism. Since we are at point number 11, conservatism, and revenue recognition is related to that, at point number 7, revenue recognition, an important concept is, let us suppose you have a contract which is spanning over a period of 7 years. Question comes up is, when do I account for the revenue? Because my entire contract will get over at the end of year 7. So do I need to wait till year 7 to account for revenues? No. There is an accounting guidance which says that pro rata concepts can be followed. As and when you complete a portion of the contract and you become eligible for the revenue, please go ahead and account for the revenue, and the balance portion of the revenue which is supposed to be earned in future will be taken care of in coming periods. Till such time, all such monies which are received in advance towards the contract are treated as a liability and shown as a liability in the balance sheet, but anything which you have already completed and which is already due to you as per contractual terms are taken to profit and loss account and recognized as a revenue. So this is the revenue recognition, and this also takes care of your conservatism. Whatever is not due as a revenue is carried forward in balance sheet and shown as a liability. Coming over to 12th concept, the materiality concept. The materiality concept means you should go ahead and account for transactions which are material. Small value transactions which do not affect the financials and are very insignificant may be taken as a liberal view. So expanding on both these two concepts, let us suppose as a business we come to know that there is a liability which is going to happen in the very near future, and it is very certain because of certain change in laws, because of certain change in the global scenario, because of certain changes in the geography in which you operate. You know certain expenses are bound to come. So you basis these, either you should go ahead and make a provision in the books of accounts, or if provision is not possible because still things are uncertain, then you would need to disclose this information in your financials. Why this is important? Because when you disclose such information in the financials, the users can take informed decisions. They have all the aspects ready in front of them, and that will help them take informed decisions. Now coming back to the second aspect, it's not necessary that you should disclose each and every information. Let us suppose you have purchased a stock of erasers as a stationery for your organization. In the year, certain erasers may be used up while certain stock of erasers may still be there. However, considering materiality, all the purchases of the erasers are written off to expenditure. They are not carried forward as an inventory or as a stock in the books of accounts, considering the materiality aspect. Moving over to the third concept, the objectivity concept. We account for transactions in our books of accounts basis vouchers and supportings. So vouchers and supportings are always preserved for a period of time which is governed by laws of the country or the geography in which the company operates. So this will help people go back to the transaction, test the transaction, auditors can go ahead and check it up, and they can take an objective view. At the same time, we also ensure that we account transactions in our books of accounts basis the historical cost concept, not the market value concept, because historical cost concept is not having any subjectivity attached to it, while market value keeps on fluctuating, changing, and it is a very subjective concept. So that is the reason why we go ahead and we follow objectivity concept by accounting transactions at historical cost, and at the same time ensuring that all the transactions are backed up by vouchers and supportings. Now, moving over to the 14th concept of accrual, which we have briefly touched upon early, means we should go ahead and account for all our expenses and income once they actually are incurred or when they actually happen, and not when they are actually paid or received. This has been briefly touched upon, or this has been touched upon at point number 7, revenue recognition. And accrual as a concept is applicable to both income and revenue. As against accrual concept, which we have discussed upon, means you account for your income when you sell the materials and the customer becomes legally entitled, not when the customer pays. Similarly, expenses are to be paid when they are incurred on and not when they are actually paid. For example, rental cost, which we have discussed. As against to accrual concept, there is another concept called cash concept, cash accounting, and which is a very simple concept of accounting where transactions are accounted when cash is actually paid out and not when they are actually incurred. This is a very raw or a very basic form of accounting, but as the business grows and as we need more transparency, we need more clarity on the earnings or the profit of the company, cash system of accounting may not be scientific and correct, and hence accrual as a concept becomes very critical. Means we accrue for all the income, we accrue for all the related expense, and that's how we get the profit or loss, which is the sort of a results of the operations of the business over a particular period. So accrual as a concept also is very important, which helps you give the correct picture of the affairs of the business. So that is the reason now we also have touched upon the two important bases of accounting, which is the cash and accrual. Now, after understanding all these concepts, we are better equipped to understand accounting standards. What is the need for accounting standards? What is the benefit of accounting standards? And what are the limitations of accounting standards? Now, because we have learnt about consistency, we have learnt that when we are consistent, we are able to compare results from one period to the other, from one company to the other. Now, to bring consistency, there has to be a set of guiding principles which are known as accounting standards. So, various accounting bodies like ICAI, Companies Act, etc., and globally US GAAP, etc., they have come out with accounting standards. How do you account a transaction? When do you account a transaction? Whether you should make the accounting transaction as part of the income statement or the balance sheet? When do you have to bring it to the profit and loss account? All these guidance is provided by our statutes, various accounting governing bodies like ICAI, Companies Forum, and US GAAP related governing bodies. All these they give you accounting standards when you have to do and how you have to do the accounting. What happens is when everybody follows these accounting standards, like for example, if you are making Indian GAAP books of accounts, you have to follow Indian Companies Act, you have to follow Indian accounting standards, and every Indian company will have to follow all these, else the auditor, if you do not follow, auditors will qualify. So everyone follows these accounting guidance, and because of which the accounting statements, financials are comparable not only across companies but also over periods of time. So the benefit, we have also understood, the benefit is because comparison is possible, everyone follows the same accounting principles. So reading and understanding the financial statements becomes very easy, and over a period of time it becomes the accounting language. However, accounting standards have their own set of limitations. It goes with anything which is made common across. There may be situations, there may be a time or a situation in a particular for a particular company when the particular accounting standard may not reflect the correct way of accounting. So there may be a rigidity which may be introduced because of following the accounting standards. You may not be in a position to change the accounting standards quickly, because if you change your accounting standards quickly, your results may not be comparable, and that may not be something which may be encouraged also, because it may show a very it will give a very poor picture about the company which keeps on changing its accounting methodology basis the various guidances given in the accounting standards. So considering consistency, when you follow a particular accounting standard or a particular set of accounting principles, you have to be consistent, and you have to ensure you keep on following these principles unless and until there is a change which happens in the way the business is being conducted, and you feel the accounting standard is not reflecting the transactions in the true and correct manner. In that situation, you can go ahead and change your accounting standards, but you have to disclose the fact of the change, the financial impact of the change, so that the reader is in a position to take an informed decision. So even though accounting standards bring in rigidity in the form change is not flexible, but at the same time it gives you a way out to change, and at the same time it gives you the flexibility to change with proper disclosures. So to that extent there are limitations, but limitations are there for the benefit of all concerned, for the benefit of investors, government, general public. So overall accounting standards have more benefits, and limitations are there, but they have been overcome if you follow the guidance which are provided. Coming over to GST, that is a topic in itself, and we will touch upon it in our next session. Till that time, thanks and bye.